I believe the numbers were phony, just like they were before the election. And there were other times. So you know what I did? I fired her.
Right.
And you know what? I did the right thing.
President Trump on firing his data chief after Friday's disappointing jobs data. At the same time, the weak hiring reading is now making the strongest case yet for what Trump really wants, the Fed to cut interest rates. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks are lower for a seventh straight day as weak U.S. jobs data sparks concerns over economic momentum. OPEC Plus agrees to boost supply just as signs emerge that Trump's trade war may be weighing on global growth and energy demand. Veteran emerging markets investor Mark Mobius has been taking shelter in cash, but as Trump's policies hit the dollar's haven status, we'll ask him whether it's time for a rethink. For the markets, it's really about the jobs data shaping market sentiment. Asian stocks extending declines, but it is really about Treasuries yields surging on Friday on those jobs data pretty much across the board. 10-year yields dropping 16 basis points. If you remember, 2-year yield, which is ultra sensitive to policy, dropped 28 basis points. Of course, the jobs data prompting expectations the Fed will cut twice this year, with the first move possibly in September. 90% probability being priced in by the market that will happen. We're also keeping an eye on the dollar. Little change at this point in time after posting its first month of gains this year in July. And we're keeping an eye, of course, on oil. You bet. It's where we're seeing big moves. OPEC Plus said it will raise output by more than 500,000 barrels a day, reversing a 2-year output cut, prompting expectations of an oil glut. Take a look where Brent crude currently is $69.50. New York crude $67.22, both down about 0.2%. Now let's talk about the uncertainty on the dollar's outlook with our next guest, who told us last time that he was 95% in cash. Mark Mobius is chair of the Mobius Emerging Opportunities Fund. He joins us from Osaka. Mark, good to have you with us. So still keeping 95% in cash?
Now it's about 50% in cash.
Why is that, Mark?
Basically, I think the markets have gone way too high for bargains to be found. I mean, it's all about valuations. If you look at the valuations of most of the companies, they're very high. Expectations are high. Of course, often we get a situation when people are very cautious. That's a time when the market will go up, and it's possible that will happen. But I would say cash is king right now, and when there's a correction, we'll be in buying aggressively.
But we're looking at a dollar that is weakening, and with expectations of 2 cuts this year, the dollar has had it even lower. I'm just wondering why it still makes sense to hold cash at this point.
Well, don't forget, with cash, you can get 4 to 5% interest. So this is very, very nice interest and safe interest in U.S. Treasury. So the benefit of holding cash is very good at this stage of the game. Now, of course, there's some opportunities in the market, and we've taken them. As I said, we're about 50% in cash now, but 50% in stocks. And as you know, emerging markets in particular are beginning to look brighter. In fact, in the last year or so, they've kept pace with the U.S. market, which is good news. And I expect further strength ahead once these tariff negotiations are completed, which will probably be happening in the next 4 or 5 months.
Mark, you talked about deploying some of that cash. Where have they been deployed?
Believe it or not, here in Japan, I'm now in Osaka, Japan. And in Japan, there are great opportunities, companies that are having very good earnings, very low price earnings ratios, good growth. And of course, as you know, the Bank of Japan the policy rate now is about 0.5%. It's expected to rise, but not by very much. Inflation is about 2.7%, so it's not a big problem here in Japan in terms of rates. So Japan is a good opportunity. The other opportunity I would say is in India. As you know, I've been a big bull on India for quite some time, and Taiwan. Those are the three areas which I think hold a lot of promise.
And also, these are the three markets which have been slapped with pretty high tariffs by the Trump administration. India, 25%, very unexpected. Might that shape how you look at the Indian market and what the opportunities are there?
Well, you know, the great thing about the Indian market is it's a self-contained market. As you know, it's one of the most trade restrictive markets in the world. If you look at not only tariffs, but non-tariff barriers are huge in India. So it's very self-sufficient in many, many ways. So they really don't need a lot of exports or imports. So that's one big benefit of being in India. The tariff situation is not going to hit them very badly, and they will probably hold out for a better deal with the U.S. at the end of the day.
How would you deploy your resources in India? What's looking attractive, bearing in mind that Modi is now calling for his citizens to buy India?
Well, consumer products, consumer companies, of course, will be very good. There are a number of retail listings that look attractive. But you could look at any sector. You could look at the airlines. As you know, the airlines in India have been growing at a very fast pace, but more importantly, in the telecoms area. There are great telecoms companies. Bharti Airtel comes to mind. These are companies that are doing very, very well in the Indian market and will continue to do so.
The thing is, Mark, despite the catalyst that you mentioned earlier, the Indian market has struggled the last few months. What would it take for it to have a turnaround?
Well, I think, first of all, you have to look at the Reserve Bank of India. RBI has cut rates from 6 to 5.5, and inflation is now below 4%. So there's a good opportunity for the RBI to cut even further, which would be bullish for the market. That's number one. Number two, these battles with the U.S. on tariffs, of course, is having an impact, a psychological impact, but this will be short-lived in my view. So the opportunities are still there. And if markets in India, some prices have come down, it's probably a good opportunity to buy.
We have seen a flood of primary issues. I'm just wondering whether you think that may weigh on India's secondary markets.
Of course, that situation of a lot of IPOs, a lot of new companies coming on the market draws money, and therefore the other part of the market, the listed part of the market, suffers as a result. So yes, I think this will continue for a while, but it's not going to go on forever. And when that ends, then of course the entire market will benefit. But you must remember, IPOs are good for the market because it gives the investor lots of more choices, which is good overall.
Mark, overall, the market's pretty concerned about the tariffs that we've seen imposed by Trump, and some have seen very hefty tariff levels. I'm just wondering, on balance, how are you assessing the impact of those tariffs on market sentiment?
Of course, the sentiment has been very bad, as you know. Tariffs have scared a lot of people. A lot of people think that tariffs will result in higher inflation. Tariffs will result in poor earnings for some companies that depend on imports and exports. So there's no question that tariffs has been the number one item that drags down the market. And we're looking now at between, 15% to 41% tariffs, but negotiations continue. And another interesting point to remember is that a lot of this is in the courts in the U.S. Federal courts in the U.S. may invalidate a lot of the tariffs that the Trump administration has instituted. So this is another a sort of uncertainty that we're looking at down the market. But nevertheless, the taco mentality is now gone away. People are beginning to see that Trump will not back away in many of these areas.
So, Mark, uncertainty remains. It hasn't been cleared, even though now we have the numbers attached to the tariff threats.
Yeah, of course. You have to look at this long term. All of this talk about tariffs, up, down, sideways, what they're going to do from day to day, that's a lot of noise. The ultimate thing that we've got to take home is that things have changed dramatically in the trade environment globally, not only the US. People are looking at this much more realistically. There's going to be a lot of thinking about how to make things fairer for all countries involved. So I think at the end of the day, it will be a better world that'll emerge in the next 6 or 7 months, where trade negotiations will have completed and we'll have a much more fair trade situation globally. Now, of course, the big problem, of course, is China. Is China willing to reform and do away with all the non-tariff barriers? By the way, that is the big issue. The tariff rate is one thing, but the non-tariff barriers in some of these countries could fill a book. These are the things that have to be negotiated. And I believe that if negotiations with the US and China are successful, a lot of the non-tariff barriers will disappear. And that will be great, not only for the US, but for other countries trading with China.
So when it comes to China, Mark, is it fair to say that you should adopt a wait-and-see approach until there's greater clarity in terms of negotiations between the two sides?
Yes, I think it's a good idea to wait, maybe nibble a little bit. There are a few people that are recommending companies in China, but I would say there's no rush. Yes, the China market has done well recently, but I think there's plenty of time to get in once we see more clarity.
Where do you nibble, Mark? Would that be maybe the AI segment of the market?
Yeah, that's one area. And tech generally speaking, that would be a good area. Some of the names that you see in China are very, very interesting in terms of technology. So this is where we would want to look.
Would you be buying Indian tech for that matter, Mark? Some say that perhaps when you take a look at the recent earnings, the numbers weren't great. Maybe that is a sign that India's tech sector may be weaning in terms of its attractiveness?
Yeah, I think there's been a lot of emphasis on Indian tech. But I think what you have to do is look at India as a whole. In other words, as a consumer market, as I mentioned, consumer stocks look good. Of course, every stock that we look at, we try to find those that are using technology to improve their behavior and improve their performance. And there are many of those. So whether you're looking at the retail, whether you're looking at manufacturing, whether you're looking at telecoms, you have to focus on what kind of technology they're using and how are they using technology to improve their productivity and to improve their earnings growth. And there are many, many of those in India. And of course, many of the new markets in India will be markets that relate to technology.
What's the biggest risk in investing in these tech names, Mark? Because we know that there's a big focus on the Max 7. We're seeing those stocks fluctuating in a big way, and that will impact the rest of the tech plays in the rest of the world.
Of course, the big risk is competition. More and more companies are piling into AI and improving their AI capabilities. So you have to keep an eye on what companies are going to be overtaking others. So this would be the big risk going forward. But you must remember that some of the bigger names, some of the names that are ahead of the game, will continue to be ahead of the game. And those are the companies that you want to focus on.
We know that you're an emerging markets guru and you love India. I'm just wondering, when you take a look at the macro level, do you see Asian emerging markets outpacing perhaps those, rivals in Europe, for instance?
This is going to happen. As I said, generally speaking, these trade negotiations will end probably in the next 6 months or so. And that time we'll see a lot more clarity. So markets like Korea, Taiwan, Vietnam, Thailand, Malaysia, Singapore, Indonesia will all continue to look very, very interesting with lots of innovation coming in play. So I think at the end of the day, these countries will continue to do well. And if the Chinese come to the table in terms of much better tariff structures, eliminating a lot of the non-tariff barriers, then these countries will look very, very good, because their major trading partner, of course, has been China and will continue to be China.
Some of these markets have had a stellar run already. The Kospi, case in point, up 35% year to date. How much more upside, and what could be the catalyst here?
Well, yeah, that's true. Some of these people have begun to realize that bad news doesn't go on forever, and there's a great opportunity again now. But I think that's just the beginning. At the end of the day, it's only after we see what the tariff rates are going to be and what trade with the U.S. is going to look like, that we'll get a clearer picture. But yes, a number of these markets have moved up. One of the reasons why is that in a case like Taiwan, for example, everybody knows that the technology sector is going to continue to do very, very well. And it doesn't make any difference what the tariff rates are with the U.S. They will be able to export. And the U.S., of course, depends on Taiwan for a lot of technology. So they're not going to kill the goose that lays the golden egg. So again, I think some of these markets will see recovery.
Mark, even as we talk about the potential of Asia and emerging Asia in particular, we've seen a stellar run for the S&P, still hovering at record highs. It does seem like the story of U.S. exceptionalism is persisting, and traders are still preferring the U.S. market to other parts of the world.
Yeah, I mean, that's probably the most interesting thing that's happened in the last, let's say, roughly 10 years. And that is, number one, a lot of emerging market stocks have moved to the U.S. market, have listed in New York and NASDAQ, in New York Stock Exchange and NASDAQ. That's number one. Number two, a greater proportion of the earnings of U.S.-based companies are coming from emerging countries. Of course, internationally, they've been trading internationally for a long time, but a greater and greater proportion are coming from emerging market countries, because those emerging market countries have been growing at double the rate of the developed countries. The other thing that's happening is that the percent of their supplies have become dependent upon emerging countries. Now, of course, Trump would like to eliminate that supply chain and bring it back to the U.S., but I don't see that as possible. This will not happen. For example, very unlikely that the U.S. will become a major producer of plush toys. That's probably not going to happen. So a lot of the supply chain, which we see now, will still be in existence. And these countries, particularly in Asia, will continue to do well in trade, not only with the U.S., but with Europe as well.
Mark, if you take a longer-term perspective, in this case 3 to 5 years, what do you see as the big trends that investors should be looking at and investing into?
I think the number one big trend is a move by more and more countries towards some free market environment. We now see a separation in the world between the U.S. and countries like the U.S., who have a free market environment, Japan, Canada, Mexico to some extent, Europe, etc., and countries like China, India, Russia, that are not in that camp. India, of course, is in the free market camp, and I forgot to mention, India is very important in that regard. So I see a growing bifurcation between these two groups of countries. Now, the degree to which this changes, in other words, the degree to which China becomes a free and open market, will have an incredible impact globally, because China is a big, huge country, second largest economy in the world, according to some economists. But at the end of the day, if they are going to convert from a closed economy, which they are now, to an open economy, this will have an incredible impact globally. So I think that's what we have to look at.
Mark, before we let you go, we know that you're launching your latest fund, but that has yet to happen. Is there any indication at all when we can expect that to happen?
Probably by the end of the year. We've already started. We have some investors, friends and family mainly, but we don't want to have a full-scale launch until we're able to get into some of these markets. As you know, negotiating with each of the countries in which we want to invest takes quite a while. And hopefully by the end of the year, we'll be able to get into these countries and be able to invest. And then we'll be ready to go full scope and really move very quickly.
So November, perhaps?
Yeah, probably November, or maybe celebrate Christmas.
Looking forward to that, Mark. Thank you so much for joining us. Mark Mobius, chairman of Mobius Emerging Opportunities Fund. Let's do a check on Thai Airways. It is surging as it resumes trade for the first time in 5 years. Of course, this is an airline which has been restructured, exiting a $12 billion debt restructuring. It is up currently as we speak. Thai Airways resuming its trade after 5 years. It is a positive kickoff for the airline. Now, still ahead this hour, Vanda Insights founder Vandana will be joining us as we take a closer look at key drivers in global energy markets, including the latest OPEC Plus output increase. Keep it here with us. This is Bloomberg. Welcome back to Insight, and this is how it's looking for Asian benchmarks. MSCI Asia Pac Index currently in negative territory on the back of the lower than anticipated jobs data. All of a sudden, they say we're back to worrying about the U.S. economy. Of course, there's jobs data front and center. Keep an eye on the Hang Seng. It is one of the winners today, up by 0.5%. Tech plays are in play at this point in time as well. We're taking a look at the U.S. dollar, currently down about 0.1% lower for a second day in a row. And it's shaping up to be a positive start for the U.S. market futures, pointing to a higher open. Still to come, OPEC Plus closing up a 2-year chapter in its oil strategy with a further output increase, but the group still has unfinished business. The details on that cliffhanger next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We're keeping a close eye on the oil market under pressure after OPEC Plus decided to ramp up production by more than 500,000 barrels a day, reversing the cuts it's done earlier. Goldman maintaining its 2026 Brent forecast at $56 after that OPEC Plus move, and it says it expects the OECD stockpiles to continue to expand. Let's get perspective from Vandana, founder of Vanda Insights. Vandana, good to have you with us. You say the move was pretty expected. The thing is, it's coming at a time of fragility for the oil market.
Good morning, Haslinda. So OPEC made that decision to accelerate the return of the 2.2 million barrels per day of voluntary cuts a few months ago. At that time, it was a bit of a surprise for the market because initially OPEC plus this group of 8 had said that they would do it very, very gradually over a period of 18 months. And now where things stand is that within a period of 6 months, between April and September this year, they will have returned all of that 2.2 million barrels per day back to the market. One of the factors that has given them the confidence to continue on this accelerated track after they began about 4 months ago is that there hasn't been a major slump in crude prices. So, had you put out this plan, let's say 4 or 5 months ago, and asked market participants what is it likely to do, they would have predicted below 60, below maybe even $50 crude prices, whereas we've seen them pretty much range bound if you're talking of Brent around $70 a barrel. Now, why that is the case, even in the context of sluggish demand outlook, is that we've had a lot of geopolitical factors in the play, and those have kept prices a little bit higher.
So the market is not as oversupplied as some have made it out to be, yet others are saying expect a glut by winter.
So the jury is still out on that, Haslinda. I would say it's not necessarily a uniform balance in the market that we're seeing. I think the market, pretty much the consensus view now is that the Northern Hemisphere summer months, which is what we're right in the peak of it right now, roughly over April to September, are seeing a relatively strong demand. Jet fuel demand has been very good. People are still flying around. Gasoline demand in the US has been a little bit under pressure, but nothing very worrying. So the summer months demand is seen good, and we aren't seeing a major build in inventories that people might have expected in an accelerated OPEC plus unwinding scenario. But what the market looks like starting the fourth quarter of this year and going into next year, I think that's where right now the expectations are for a little bit of a swing back into oversupply.
Isn't demand being supported by the very busy summer travel season? And also we have Trump saying that he is keen and he's determined to end the Israel-Iran war. That would have implications on supplies.
So the Israel-Iran war is a bit, I would say, Haslinda, in the rearview mirror for the oil market. Right now, the focus is very squarely on the war in Ukraine and Trump's threats, and which have gone bigger and bigger in recent days, to President Putin to agree a ceasefire. And then, of course, on the other side, Putin has not been very accepting of these ultimatums. But that is a real, and I mentioned earlier, the geopolitical risks hovering over the oil market. And this is a major one right now. Trump in last week threatened secondary tariffs on India. Some of the other U.S. officials have mentioned up to 100% or even more secondary tariffs on India for buying Russian oil. And how much of this is bluff and bluster, and how much Trump is actually willing to implement, we don't know. It's a brand. It's absolutely out of the left field for the oil market. We haven't seen this animal before, secondary tariffs for companies or countries buying Russian oil. But all said and done, at the end of the day, that is keeping a little bit of a geopolitical risk premium in crude prices right now.
Vanda, now we know that OPEC Plus still has 2 other tranches of cuts. What do you see OPEC doing in the coming months?
Yeah, so with this 2.2 million barrels per day fully back in the market by the end of September, there's another roughly 3.7 million barrels per day implemented by the wider 18 members of the 21-member OPEC Plus group, which predate these 2.2 million barrels per day of cuts. And as of last December, OPEC Plus had agreed to continue these, leave them in place until the end of next year, December 2026. As of now, so of course, the market has now begun talking about, could these be, could OPEC Plus start to unwind these as well now that it's done with the 2.2? My personal view is that they will now wait and watch, see how the market continues to respond, especially as we go into the, slower season, Q1 of next year. I don't expect them to be in a hurry to bring back that remaining 3.7 million barrels per day.
So what does it all mean in terms of oil prices going forward? We have Goldman saying 64 for Q4, 56 for 2026. Do you share those estimates?
So first of all, with the caveat, Haslinda, that there's a huge deal of uncertainty, simply because a lot of the steps that Trump has been taking, and not just steps, but making threats, climbing down, U-turns, and he's added a whole lot of uncertainty, especially on the geopolitical risk side of oil prices. We saw that with first his administration was talking to Iran. It seemed for a while that there would be an Iran deal, and then Iranian oil flows will return to the market, and now we're in a completely 180 degrees position to that. Last week they tightened further the sanctions against Iran. Similarly, Venezuela has been on and off with allowing Chevron to go in and then stopping them and so on. And the big factor right now is his threats to Putin on Ukraine. And threatening essentially to crimp Russia's oil supplies to the market. So it's very, very, very uncertain, specifically because of Trump's constant U-turns. I expect, given that, stick my neck out and say probably high 60s is the sort of average I see for Brent prices through the second half of this year.
So pretty resilient still in terms of oil prices. When you talk about supply, you have to talk about shale output production in the U.S. We know that Trump is keen on drill, baby drill. Where are we with that?
That jingo has been lost now. It's gone back. It just brings a chuckle and a smile and a wry smile to people's faces in the industry, especially those who know what's going on in the ground in the shale patch. And the numbers speak for it, Haslinda. The rig count in the U.S. oil patch, the fracturing fleet count are now languishing at 4-year lows. For the past many weeks, few months, the shale producers have actually been cutting back on this. Look, as far as U.S. oil production is concerned, yes, it is sort of at fresh highs, around 13.5 million barrels per day, but all signs right now are pointing to it stagnating. I suspect that we'll start seeing that stagnation very, very soon, before the end of this year. And unless WTI, for whatever reason, let's say jumps well above $70, $75 a barrel, I don't see that happening. Unless that happens, I don't see the U.S. shale producers changing their strategy. Right now, it's absolutely hunker down position. Increase their free cash flows, and which means in turn as little activity as possible in terms of drilling and completion, basically just going into maintenance mode, trying to offset the very, very steep natural decline that happens in shale. I feel right now the rig count and the frac count is actually going below maintenance levels. So, which is why I think we're going to see stagnation to perhaps maybe even a dip starting to come about in U.S. oil production. Trump's not going to like that, but that's bizarre.
Just to pivot a little bit, we're seeing a fraying of relations between the U.S. and India on the back of India's purchases of Russian oil. I'm just wondering how do you see this story developing? Because India's been pretty adamant about continuing the purchases.
Yeah, well, first of all, Haslinda, I'm a bit surprised at how misinformed some of these public statements coming out of Trump's senior officials appear to be in terms of understanding market dynamics. Even awareness that in 2022, when the U.S. led the G7 to impose strict embargoes and sanctions and the price cap on Russian oil, they actually needed and wanted India and China to absorb all the Russian crude that was now being shut out of Europe. They heaved a sigh of relief that India was able to do that, and now completely singing a different tune and sort of pretending that, how did this happen? Haslinda, how much time do you have? I could go into this. And Europe is still buying billions, tens of billions of dollars in annual purchases of Russian LNG, directly, mind you, Russian LNG, fertilizers, metals, nuclear materials, and so on. So the policy is all over the place. And you're right. Yes, India is pushing back. I expect them to continue pushing back. Also, it's going to be very bad optics for Trump if he imposes the secondary tariffs on India for buying Russian oil and doesn't do so on China, which is a bigger buyer of Russian oil, simply because, who knows, he's a little more intimidated by how China might react.
Isn't it difficult for India to undo those purchases as well? Because Russian oil now accounts for up to 40% of its oil imports.
Actually, no, it's not. India could very easily go back to where it was pre-2022, when it was buying zero Russian oil, Haslinda. So India could just simply go back to, not all the producers, especially the OPEC Plus group, have spare capacity, but the Middle Eastern producers who have provided the bulk, the mainstay of India's crude imports for decades, like Saudi Arabia, UAE, Iraq, they could certainly, start putting more barrels into the Indian market. So it's not an issue. I think where it will hurt is that the discounts that the Indian refiners have been enjoying with more than a third of their crude coming from Russia over the past couple of years, that discount will disappear. The big question is, what will that do to global oil prices and pump prices in the US? And, how is Trump going to handle that?
Vandana, as always, great perspective. Vandana Hari, founder of Vanda Insights. Now, staying with India, Indian Prime Minister Narendra Modi has struck a defiant tone in the face of President Trump's 25% tariff rate. He's urging citizens to buy locally made goods while New Delhi continues to buy Russian oil. Bloomberg South Asia economy editor Ruchi Bhatia joins us now from the Indian capital. Ruchi, tell us more about this Modi's Buy India message and what this means for the government's wider strategy.
Well, absolutely right. U.S. President, you heard Vandana Hari also there talking about the U.S. President last week saying that it was good that India stopped buying Russian oil, but India making it very clear that the ties between India and Russia are, they've stood the test of time. They're very strong and stable over the last 7 decades. And perhaps the reason why we heard from Indian officials over the weekend saying and making it very clear that there's been no implicit instruction that has been given to Indian private or state-run oil refiners over Russian oil. Having said that, these comments coming in the backdrop of the Indian Prime Minister Narendra Modi making it very clear that to overcome the geopolitical situation that we are in right now, Indians should look at buying more Indian goods. Remember, Atmanirbhar Bharat or Vocal for Local have been long time slogans for this government. They've been trying very hard, but remember, India also buys a lot of imports or gets a lot of imports from China. So it will be a tough balancing act, even as India looks to navigate through this crisis that's, of course, playing out. As I said, this is coming in the backdrop of Prime Minister Narendra Modi urging Indians once again to buy locally, to shield the Indian economy from the geopolitical crisis that is underway. And remember, the mood back home is also kind of shifting towards more economic nationalism in the wake of the India-US developments playing out. We really don't know where the relationship is headed, even as India has been maintaining that the talks with the US will continue. There is a trade delegation from the US that will be visiting India on the 25th of August. But this space is becoming more and more interesting. And it will be interesting, remember, Haslinda, to see as to whether India is really able to clinch that deal. Where do we go from the 25% tariffs, and what really happens to the undefined penalty that US has been talking about because India is buying more Russian oil?
There has been massive pushback, of course. The question is this enough to address the growing domestic criticism of Prime Minister Modi?
Oh, yeah, absolutely. I mean, look at, for example, the Modi has been making these calls, Haslinda, but at the same time, the Indian economy is also not doing very well. I mean, India is growing only at about 5.5 to 6.5%. There are these global concerns, even as the monsoons back home are pretty good, and we're seeing the rural economy pick up. The urban economy is still, is not picking up the way that India had anticipated it to be. So there are those concerns as well. So we need to see, as you rightly pointed out, whether all of this is going to be enough or not.
Why is India's relationship with Russia so important, Ruchi, even in the face of 25% tariffs?
As I said, Haslinda, the relationship between the two countries is not from today. It dates back the Cold War era. India has had a very stable relationship with Russia over the last 7 decades. In fact, if I can point you toward what Subramaniam Jaishankar said a couple of years ago, he said that in this, world, the only constant that we've seen this, with all the geopolitical uncertainties, is the kind of relationship that India and Russia have had. And remember, India refrained from openly criticizing Russia. India, in fact, even abstained from the UN resolution on Russia. India has been, sustainably buying Russian oil, Russian weapons as well, and is a part of, the BRICS bloc as well. So this relationship is very, very strong over the last few years. Both countries have really refrained from talking about each other's internal politics as well. So this is primarily the reason that there have been no upheavals in the relationship, so to say. And in the last 7 decades or so, this relationship has been on a solid footing.
That's right. A relationship that's been time-tested, India says. Ruchi, thank you for that. Bloomberg South Asia economy editor, Ruchi Bhatia there. Let's do a check on Indian markets. Have been trading for about 2 minutes now. We're seeing some gains in the get-go of the India Open. Let's take a look at where we are in terms of those benchmarks. The Sensex currently trading up by 0.2%, and the Indian rupee trading higher versus the USD by 0.3%. Still to come, we take a deeper look at how India's tech sector is faring amid underwhelming earnings and reports of job cuts at an industry leader. Keep it here with us. This is Bloomberg.
Of course, the big risk is competition. More and more companies are piling into AI and improving their AI capabilities. So you have to keep an eye out what companies are going to be overtaking others. So this will be the big risk going forward. But you must remember that some of the bigger names, some of the names that are ahead of the game, will continue to be ahead of the game, and those are the companies you want to focus on.
EM guru Mark Mobius, chairman of Mobius Emerging Opportunities Fund, speaking to us earlier in the show. But market concerns are growing around Indian IT stocks, which have erased about $100 billion in value this year. The Nifty IT index tumbling 11% since the end of June amid disappointing earnings from the likes of TCS, HCL Tech, and Tech Mahindra. Indian IT firms have largely missed the AI-fueled rally, lifting tech stocks around the world. Let's get more details on the headwinds facing Indian tech stocks with our Asia equities reporter CJ Chakraborty in Mumbai. CJ, talk to us about why this sector has been missing out on the AI boost so far.
Well, it seems like they have turned into one of the losers of this AI rally, largely because a lot of the low-cost specialized services that they used to provide corporations all across the world, particularly in the US, are being replaced by AI. And these are low-tech, low-cost jobs, which were earlier a specialty of a lot of Indian companies, and they have, of course, made a lot of money out of that. But those jobs are slowly inching towards AI, towards automation, and therefore it is affecting the billings and the client demand that a lot of Indian IT firms are seeing right now.
Suffice to say, the earnings weren't great, a huge disappointment. Some say TCS now reportedly planning to cut jobs as well. When it comes to a possible sector rebound, how are we looking at that?
Well, Jefferies this morning, said that they are expecting a tactical rebound, largely because valuations, if you look at relative to the benchmark Nifty 50, are becoming much more comfortable. And that is one of the biggest reasons they are expecting a tactical rebound. But mind you, they still warn that the longer-term outlook for the sector still remains quite dim on the back of slowing down of client spending in the US. And let's not forget the weak, U.S. jobs report that we saw last week. That has now raised fresh concerns over the U.S. economy, which is never a good news for the Indian tech sector.
Which ones might just see a turnaround, CJ?
Well, at this point of time, Jefferies is expecting Infosys to be the one to stand out. TCS, of course, as you pointed out earlier, they are seeing retrenchment in terms of job losses. Wipro as well not doing that well. So all the hopes right now in terms of a tactical rebound rest on Infosys' shoulder, largely because it's the only one of the few companies which is still showing decent amount of growth. It raised its the lower bound of its annual growth guidance during the reporting season for Q1. Along with that, I think HCL Tech is the other one where Jefferies again, previously pointed out that they have become sector leaders in terms of growth, even though the overall growth for the entire sector has moderated and remains around low single digits.
In the meantime, today, though, that reversal is not happening. Indian tech stocks in the negative. Asia equities reporter CJ Chakraborty in Mumbai. We thank you so much for that. Now, here are some more top corporate stories we're following. Tesla has been told to pay $243 million in a lawsuit over an autopilot crash in Florida that killed a young woman and seriously injured her boyfriend. A jury in Miami federal court found that Tesla was partly to blame for the collision in 2019. Tesla says it will appeal the verdict, adding that decision is a setback to its efforts to develop life-saving auto technology. More than 3,000 Boeing defense workers are set to go on strike for the first time since 1996 after rejecting a contract offering 20% wage hikes. Boeing says it's ready for the work stoppage, but labor unrest adds pressure to its defense unit, which accounts for 30% of revenue. The company says it will withdraw its current offer to workers if it's not ratified by midnight Sunday in the U.S. And before we go, here's a look at our guests for tomorrow. Bianco Research founder and president Jim Bianco will be joining us with his insights on inflation, the Fed, and what investors should brace for next. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.